Welcome back to Gimme Some Truth. I'm Clint Walkner. This is Alicia Vande. We are here to talk taxes today. A fun topic, of course. And you are post-tax season, your first tax season at WC Tax Services. And are you recovered yet?
No, but I will be, in time for next tax season. It was definitely very different than doing it. I've been volunteering. This is my 6th year volunteering, doing taxes. And it's definitely a very different thing doing them for our clients as a paid preparer. There's different things you have to do. There's not this huge team of volunteers as a resource to call on. But we learned a lot. We got through it. All the returns that we needed to get done by April 15th, we did. And so I'd call it a success.
Yeah, I think so too. I saw you guys working really hard. I know you were working some nights, weekends, and I also take a look at the number of returns we did and the number of returns some other tax preparers do. And I'm just shocked by the job that they have to do in such a compressed amount of time. I mean, you guys did a great job on the returns that we did, and it's just an extensive review process, an extensive, comparing the last year's return to this year's return and going through that whole process. So today we wanted to focus a bit more on just things you can do to make your tax experience better, easier, not just for your tax preparer, but also for just kind of setting yourself up for success as the year goes on. And I think number one, as you've gone through a lot of tax returns, I know you mentioned this to me a lot, but people and their estimated payments, man, they're just really bad at making those. So what might be a couple tips there on making estimated payments, when you should make estimated payments, and when you should start thinking about those?
So estimated payments come into play for people who are self-employed. So you don't have payroll withholding, your job's not withholding for you. But there's a lot of other things that can cause people to have income that they're not paying taxes on. And that can be capital gains from their investments, dividends and interest, even something like bank interest. If you have $10,000 in bank interest, you're not paying taxes on that, but that's all taxable income. And not saying that that's enough alone to make estimated payments for, but just know that if you have all these different sources of income that you're not paying taxes on through the year, you're not only going to get hit with a really big tax bill, but then you're going to owe a penalty potentially for not making those payments. And you're supposed to make quarterly estimated payments. The first one was actually due April 15th. So if you do have estimated payments that your tax preparer told you to make, and you didn't make that first one by April 15th, maybe go do that. But if it's something you're not foreseeing, like let's say, you sell a bunch of stock or you take a bunch of money out of a retirement account that you weren't anticipating, either make sure there's withholding on that or make an estimated payment. So that's just, make sure you kind of know ballpark what that should be, especially if you're not employed and you don't have that withholding.
Yeah, it's a great point. Also, I noticed that just for me, now not for the state of Wisconsin, but for the feds, when I did send in an estimated payment to them, it's actually a really easy process. There's an app now they have that works really well. I had to do one for a member of my household that is pretty negligent in making estimated payments, also known as my wife. And so got a little caught up there. It was good. It went through the whole process recently, and it went really well. It was actually pretty seamless. And the state of Wisconsin wasn't bad either, but a little more manual and laborious. But the feds was super easy now.
Yeah, it is. You can do it all online, which makes it really easy. And the other thing is to keep track of your estimated payments. There's definitely been a lot of times, actually, where we've had a client either not tell us that they made estimated payments or tell us the wrong amounts. And that's a great way to get your return rejected, or to get it, take a second look at it. If you're saying you made payments that you didn't make, or, your tax preparer could say you owe a ton because if you don't tell them you made estimated payments, we can look that up for the state level, but not for the federal level. So we have no way of knowing if people made estimated federal payments. But we can look up their state payments, which is kind of cool.
That's good. Yeah. So definitely, check in with your financial advisor, look on your brokerage statements. They can run, I know we can run reports on, kind of projected cash flows and see what we're looking at. I think dividends are often overlooked there, for sure, and just seeing what your cash flow report's going to look like. And then, as you alluded to, bank accounts for sure, paying a lot more interest than they used to maybe 5-6 years ago. So it's starting to show up more and more on returns and statements. Just make sure you're able to account for those. I think also, when people do, either they're not aware of it with an advisor kind of pulling the trigger on buys and sells and rebalances. And then also, if you're looking at your own statements, or if you're self-managing your assets, gains harvesting sometimes and loss harvesting as well, just tax loss harvesting in general, great concept that I think is underlooked when we look at taxation.
And people think that you only tax loss harvest at the end of the year. And especially with the way the market's been lately, now is a great opportunity to do some tax loss harvesting. And if you're in the higher income bracket or you're expecting capital gains in future years, now's a great opportunity to do that. That's something we help our clients do a lot. And a lot of people have heard of tax loss harvesting, but a lot of people don't think about tax gain harvesting. Like, when is it a good idea to actually realize some income? If you're in a lower income year, maybe you just retired, maybe you're taking a sabbatical, for whatever reason, you have lower income, look at realizing some gains. Because if your income's low enough, you could actually be in the 0% capital gains bracket. And you don't have to take the money out of the account, but just sell some things to generate the gain. And then that's on your taxes, and you're not paying taxes on it, or you're paying a much lower rate than you would in any other year.
Yeah, that's a great point. And back to a little bit more on the loss harvesting, you're absolutely right at during the year, taking advantage of some of that. Say, for example, you have a really highly appreciated security and you have some loss carry forwards, looking at that position, and, maybe it used to be a really large position. Now it's a little less large, and you want to take some of those gains off the table, and you have a high concentration. Let's reduce that concentration risk a little bit. Let's take some of those gains off the table. A win is still a win, even if it's a little less, and you can still reallocate it to a different security. So, if you're gain harvesting, say, for example, NVIDIA, but you still want to be in the game, and you buy, Taiwan Semiconductor instead, or ASML instead, just as an example, you might not be changing your risk profile that much, but you might be diversifying your risk and also, getting that gain harvest opportunity in. So yeah, those are all great points. That's why also we're big proponents of direct indexing as well as a concept, just to go and actively tax loss harvest throughout the year.
Oh yeah, direct indexing has been great for that. It really helps daily, right? You're looking for those opportunities and building up those losses and still participating in all the market gains. And I think there's a lot of things, even without direct indexing, clients don't realize that that's something that we're doing on their behalf. Mm-hmm. Throughout the year. So with some advisors, I don't know if you have to ask for it, but I feel like we're always looking for those types of opportunities. Like, hey, can we kind of swap out what the S&P 500 fund we're using is and just use that to harvest some losses on paper, but then you're still invested in the S&P. So that's something that we're doing a lot behind the scenes, and sometimes our clients don't realize that we're always looking for opportunities like that.
Mm-hmm. Yeah, and I think one of the more overlooked opportunities as well that I don't think advisors spend much time talking about, and you alluded to it earlier with statements showing up, dividend income, interest income showing up in our statements. Asset location can be really important in making sure if you have assets in a variety of different accounts, take a look at the overall portfolio and how it's all constituted and what's actually generating income that's showing up in your 1099s, and where you can position that income to not have that happen each year and not change your overall risk profile.
Yeah, absolutely. If you're still working, you're in a high income tax bracket, you want to have, dividend paying bonds, dividend paying stocks. You want those to be in your retirement accounts so they're not adding to your tax bill every year. And then in your taxable account, have stuff that's not paying out that income and you're not getting taxed at a higher rate. Or look at something like muni bonds. For people in the higher tax brackets, muni bonds can be a great way if you don't want to change your risk profile and maybe you don't have, tax advantaged accounts to do that. Got a big taxable account, you still want it to be more conservatively invested. Muni bonds are a great way if you're in the higher income tax bracket to get actually a good rate of return after taxes.
Yeah, you have to be a little careful on duration risk there when you're selecting some funds, not get too enamored with yield there. But it's a great point, and being able to, not every muni fund is equal, but going in there, and munis are overlooked oftentimes in taxable accounts because people are just grabbing the higher yield security, or they're model based and their models are not adjusting for that person's individualized tax bracket, which is another flaw too. And that's why I do think that people need to spend some time with their advisor, making sure that they intimately understand their situation in their tax bracket. If your advisor doesn't know what your tax bracket is, that's problematic for sure.
Exactly. And that's one of the reasons we wanted to add tax services, is to help us make sure that we have an understanding of our client's tax situation. And we can certainly do that even if we're not the ones preparing their taxes. That's a lot of times we'll ask clients for a tax return, helping us understand client's tax situation, what bracket they're in, how it's going to change from year to year, makes our job easier because we can make sure that we are taking advantage of all these opportunities: tax loss, tax gain, muni bonds, traditional bonds. Like what are we doing? How are we best taking advantage of your investments to kind of match whatever tax bracket you're in?
Yeah, understanding your marginal tax bracket and also understanding your effective tax rate. And I think those are great things to look at when you start to update things like withholding. If all of a sudden you got a surprise, hey, I owe a bunch of taxes. What's the reason? And you do the diagnosis and you say, well, you're under withholding. And I think we see that a fair amount of times, under withholding, especially in places like Social Security payments, pension payments. Like, I'll just do 15 Fed 5 state. That might not do it anymore.
Yeah, if you're in the 24% bracket and you're only withholding 10%, that's not going to do it. Or I see a ton of people who don't withhold anything, and they're like, well, why do I owe so much? And it's like, well, you didn't pay anything in taxes during the year. You had $140,000 of pension, Social Security income, and you didn't withhold from any of it. So you had all this income that you didn't pay taxes on it, and now you have to. Or adjusting withholding too. I mean, that's a really good point. People get a surprise tax bill and then they don't make any changes to their withholding, and then they owe again next year, and you're like, yeah. And not that the W-4 is easy to fill out, right? The form that they make you fill out to like adjust your withholding it's not straightforward. It's not very easy to understand kind of exactly what you're doing, especially if you have two people who work, or if you have multiple jobs, or if you change jobs during the year. It's really easy to under withhold if you have more than one job, because the one job doesn't know about the other job. So they're both going to withhold at a rate that thinks that that's your only income. And then people end up with a tax bill. So
yeah, that's very interesting. That's a great point. And I think people are really bad at kind of picking their exemptions because they put down, I got a couple kids and I got a wife, and then they put the exemptions down and they don't realize that actually it's not really, that's really not the best way to calculate it. You really have to go back and look backwards into your taxable income and where that income's coming from and how much income you have, particularly if you have some of these other places that you're not withholding from. Good places too to withhold from, if you have a beneficiary IRA, which a lot of people do now. If you're taking any money out of a beneficiary IRA, perhaps even over withholding for that to kind of help out everywhere, or required minimum distributions too, right? I mean,
yeah, great point.
Great spot too.
Absolutely. Because the IRS doesn't care where the money comes from as long as they get it. So you can have no withholding on some income and then over withhold on other income. And as long as the dollar amount gets to the IRS, they don't really care how it gets there.
Yeah, exactly. And then also I think overlooked too, the role that things like donor advised funds play into people's situations. If you have highly appreciated stock, considering things, if you're charitably inclined, considering using something like a donor advised fund, I think makes a lot of sense. And just making sure that you're and understanding what years you may itemize and what years you may take the standard deduction, and that might not be the same every single year.
Yeah. And with the donor advised fund, keeping good records of any donations, whether it's contributing to a donor advised fund or making other charitable contributions. When people don't keep good records, it's hard to make sure you're getting the benefit that you're supposed to get on your taxes. Because first of all, you have to tell your accountant, right? You have to tell your accountant that you did that. And then there's other information that's needed. You can't just be like, oh yeah, I put $100K in a donor advised fund. And you're like, okay, that's cool. When? Where? There's a lot of other things that the IRS wants to know in order to give you credit for that deduction. And a lot of times, your accountant is probably asking those questions so they ensure that it's all being done correctly. Because the last thing they want is for you to get audited and then have the IRS come back and be like, actually, that's not a charitable contribution. Like political contributions, those are not charitable. You can't deduct those on your taxes. So keeping good records, whether it's for charitable contributions or like medical expenses. For lower medical expenses, that's not going to help. But for older people who have tens of thousands of dollars in medical expenses, which for people who are in an assisted living facility or who are going through some health issues, they have a lot of medical expenses, and keeping really good records of your expenses throughout the year. Same with self-employed people. keep track of your expenses, like write it down, date it, document it, like have a good record. You're going to thank yourself. Your future self will thank you come tax time if you keep really good records for that type of stuff. So will your accountant. And if that's me, please help me.
Well, especially having a separate bank account for businesses. I mean, I think it's essential. Some people still commingle. You're like, I can't believe that people still do that, but they do. And you're absolutely right about the records part of it. What do you think is a successful way to keep those records? I mean, just running Google Doc during the year, Google Drive sort of thing. I mean, what do you recommend to people?
It kind of depends on what your business is and what you have going on. For some people who, it's a pretty straightforward thing. They, income comes in one way and they only have a handful of expenses. You could just throw it all in a spreadsheet and that's fine. And just date it, document it, categorize it. Some people like to use like QuickBooks or some other software where they can connect their bank account and then categorize the expenses as they go throughout the year. We use something like HubDoc where we can like take pictures of receipts and then categorize it, and that all gets like aggregated during the year, and that is really helpful. So depending on how much in expenses you have and like how many different categories, there's different ways you can keep track of them. But pick a system that you're actually going to use. I think that's probably the most important thing, is if it's too complicated and you're not going to use it.
Right. And put a calendar invite for yourself to clean up some of those things monthly or every other month, to make sure that you actually do it. Because everyone's good at doing it the first 2 times, and then it's that 4th or 5th time that they just fall off. And you're just going to give yourself so much extra time and stress during tax time, being able to cobble that together. And you don't want to miss anything, especially if you can write it off. I mean, you got to write off, don't forget it. Or like you said, estimated payments. Don't miss that either. So, many tax tips out there, for sure. Make sure that you're kind of taking a look at your current income and your investments. Make sure that you have a good picture of yourself. How are you going to shape your taxes this year? What estimated payments are you going to make? Are you going to need to make estimated payments? Make sure that your withholding is sound and solid, and then just meet with your tax professional, go through that, and make sure that you're ending up cobbling together all the records that you need, all the different things you need before tax time. Make sure that you have a successful 2025 tax year. So thank you for joining us on this episode of Gimme Some Truth. Give us some comments, drop us a couple questions if you want some things answered, maybe some tips that you want Alicia to give you, and we'll see you next time.
Walkner Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit walknercondon.com.